Now let's cover the accounting side of bonds payable and see how it's going to be recorded in all the related transactions for bonds payable. So when bonds are issued at less or more than their face amount, the discount or premium must be amortized over the life of the bond. At the maturity date, the face amount must be repaid. So let's see this example. Assume that on January 1st, year 1, Eastern Montana Communication Incorporated issued the following bonds. It has a face amount of $100,000. The contract rate of interest is 12%. The interest is paid semi-annual or twice a year on June 30th and December 31st. The term of the bond is 5 years and the market rate at the time of issuance was 12%. So you can see that the market rate is exactly the same as the contract rate or the coupon rate. So this would imply that when we record the bond, we're going to record it based on its face value. No discounts, no premium. So since the contract rate of interest and the market rate of interest are the same, the bonds will sell at their face amount. The entry to record the issuance of the bonds would be as follows. So let's assume that this happened on January 1st of year 1. So we're going to debit cash for the 100,000, which is the amount received, which is equal to the face value, and then we're going to credit bonds payable for 100,000. Again, no premiums, no discounts. And then we have just a short explanation here that says issued 100,000 bond payable at face amount. Every 6 months on June 30th and December 31st, after the bonds are issued, interest of $6,000 is going to be paid. How did we get this $6,000? It's based on the face value of the bond, which is $100,000, multiplied by the stated rate or the coupon rate, which is 12%, multiplied by half a year. And remember, this was semi-annual. It pays interest twice a year. So that's why we have to multiply the interest by half. So the first interest payment on June 30th of year 1 would be as follows. We're going to debit interest expense and we credit cash. Again, as you know, interest expense is an expense that goes on the debit side. Cash, since the company is paying cash, is going to be credited for the $6,000. At the maturity date, the payment of the principal of the $100,000 is recorded as follows. So after 5 years, when we make the final maturity payment, we're going to debit the bond payable, and when we debit the bond payable, we're canceling the bond, and we credit cash for the face value, which is 100,000. Just one thing I want to make clear for you that since this bond has a life of 5 years and it pays interest semi-annual, we expect that this journal entry related to interest would be done 10 times. So it's going to be done June 30th and December 31st of year 1, then June 30th and December 31st of year 2, and so on until the end of year 5. Now let's assume that on January 1st of year 1, Western Wyoming Distribution Incorporated issued the following bond. And it's exact same information as what we had in the previous example. The only difference is that the contract rate in this case is only 12%, while the market rate of interest is 12%. So you can tell that the market stated rate or contract rate, or what we call it the coupon rate, is less than the market. And that makes the bond less attractive compared to the market. So to make it sellable, or to make people willing to get a bond or invest in a bond that pays lower interest compared to the market, we have to offer a discount. And in this case, we assume, or we should expect, that the selling price or the issuance price of the bond would be less than the $100,000. So because the contract rate of interest is less than the market rate of interest, the bonds will sell at less than their face amount. Assuming the bond sells for $96,406, and this would be given to us, the entry to record the issuance of the bond would be as follows. So we're going to debit the cash based on how much we were able to sell the bond for. And again, we're recording the journal entry here from the perspective of the company issuing the bond, not from the perspective of the investor. So the company is the one receiving the cash, and it's receiving this discounted price, which is $96,406. Then the credited liability, which is the bonds payable, for $100,000. Since the debit and credit don't match, we have to plug in $35.94, which is the difference between the $100,000 face value of the bond and $96,406, which is the issuance price. and that would be recorded as discounts on bonds payable. One thing to remember when we're issuing the bond, and if there's a discount, the discount is recorded usually on the debit side. If the difference is on the credit, then this is a premium. In our case here, since the difference is on the debit side, we call it discount on bonds payable. This discount has to be amortized. For simplicity, we're going to use the straight line amortization to understand how the discount works. So discount on bonds payable is a contra account to bonds payable and has a normal debit balance. It's subtracted from the bonds payable to determine the carrying amount or the book value of the bonds payable. The carrying amount of the bonds payable is the face amount of the bond less any unamortized discount or plus any unamortized premium. Therefore, the carrying amount of the bond payable in our case here is the $100,000, which is the face value, minus the discount, which is the $35.94, and that will give us $96.406. Now let's see the amortization of the bond discount. So every period, a portion of the bond discount must be reduced and added to interest expense to reflect the passage of time. This process is called amortization. It increases the contract rate of interest on a bond to the market rate of interest that existed on the date the bond were issued. So we'll see how amortization works, but basically amortization is allocating the bond discount over the life of the bond. So the entry to amortize a bond discount would be as follows. We debit interest expense and we credit discount on bond payable. And it's a very systematic kind of journal entry, or I can call it an amortization entry or adjusting entry. And that is going to be very repetitive every time we are recording the interest expense. So the preceding entry may be made annually as an adjusting entry, or it may be combined with a semi-annual interest payment. And this is the exact same thing that we're going to be doing once we use the numbers or the values of the example that we had. So we're going to debit interest expense. We're going to credit the cash. The cash is going to be based on how much we paid in interest, which is the face value multiplied by the coupon rate or the stated rate or the contract rate. And then the discount would be recorded next, which is, in our case here, we're going to get the value divided by 10 payments, and that would be the amount allocated for this journal entry. And the total of these two values would be the amount of interest expense. So the two methods of computing the amortization of a bond discount are the straight line method and effective interest rate method, sometimes called the interest method. So again, for simplicity, we're going to use the straight line method, which is the simpler method to be used. Yet, for accuracy, I think effective interest rate method is usually much more objective and more realistic. So the effective interest rate method is required by GAAP. However, the straight line method may be used if the results do not differ significantly from the effective interest rate method. So again, for simplicity, we're going to use the straight line method, which provides equal amounts of discounts or premium to be written off to interest expense each period. So let's see how it works. So the amortization of Western Wyoming distribution bond discount of the $35.94 would be computed as follows. Remember, with the term of the bond was 5 years, it was semi-annual, so we take the discount on the bond payable divided by 10 periods. And how we got the 10? It's the 5 years multiplied by 2 because it's semi-annual, twice a year. So 5 multiplied by 2, that's 10 periods. So we take the amount of the discount divided by the 10 periods, and it's going to be $359.40 per period, or every period. And we're going to use that twice a year. So the journal entry would look as follows. So the combined entry to record the first interest payment and the amortization discount would be debiting interest expense, crediting discount on bond payable, and crediting cash. Remember, the discount on bond payable, when we first sold the bond, it was on the debit side. Now we are amortizing it, very similar to the concept of depreciation, so that's why it's on the credit side. So we start with the cash, which is the easy part to start with. So we take the face value of the bond multiplied by the interest rate multiplied by half, and that will be the $6,000. And then we also did the calculation for the discount on bond payable, where we got the 35,940 divided by 10, and that turns out to be 359.40 cents. And we get the total here, and that would be our interest expense. So this entry is made on each interest payment date. Therefore, the amount of that semi-annual interest expense on the bond, which is the 63.5940 cents, remain the same over the life of the bonds. So the effect of the discount amortization is to increase the interest expense on every semi-annual interest payment date. In effect, this increases the contract rate of interest to a rate of interest that approximates the market rate. And this is just a justification of why we have this kind of amortization of the discount. So let me stop here, and the next video will continue the discussion.